has had a very long day. And the topic that we are going to talk about is ESG investing. I think it's quite a novel concept here in India, still in its nascency, but I shall try to make it interesting because this is a theme that we believe will move from niche to norm over the next couple of years. So what exactly is ESG? That's something that we are going to talk about. But before we talk about what is ESG, let's talk about what ESG is not, i.e., talk about the perceptions. The perceptions on ESG are as follows. ESG investing is meant only for values-based investors, not for investors who want to make money. This is absolutely untrue, and we shall prove with evidence during this presentation. Portfolio returns are not sacrificed in ESG investing. Perhaps this perception goes back to 20, 30 years ago when socially responsible investing was considered to be a values-based investing where you invested in your values. For example, invest in funds that were at the vanguard of the green movement or invested in companies that, were very green or practiced safe techniques, etc., where returns were secondary to the theme. So the theme was more important, returns were secondary. The third and important perception is consideration of ESG factors is contrary to fiduciary duty. We think that this is completely untrue. Anything that is material or financially material becomes a fiduciary duty, and hence we think that ESG investing is very much part of fiduciary duty. I think this quote more than summarizes what ESG is all about. I won't read the quote, but without referring to ESG, Warren Buffett was pretty much talking about how important ESG issues are. Basically, the conclusion is, in times such as now, a company must invest in the key ingredients of profitability. It's people, communities, and the environment. So now, having talked about what ESG is not, let us talk about what ESG is. In a nutshell, ESG is all about a corporate and every stakeholder of a corporate. For a corporate, who are the stakeholders? The stakeholders are its shareholders, its employees, the regulators, the customers. Now, therefore, when you take into consideration all the ESG issues, you're taking into consideration the relationship of a corporate and the likely risks that emanate from all these stakeholders for the corporate. And therefore, you look at this entire perspective from three factors. The environment, where you look at various different issues with regard to how responsible a corporate is with regard to the environment. That probably may refer to how responsible the corporate is with regard to pollution norms, emission norms, plastic usage, renewable power, depending on the kind of industry the corporate works in. And similarly, governance as well, social factors as well. I won't go into the details given the paucity of time, but you can get an understanding of what this really means. Consideration of factors, risk factors, as well as opportunities under each of these verticals, which would pretty much complete the entire analysis of an organization and its relationship with every stakeholder. This theme has been gaining in momentum, as we shall see in the slide after that. But in this slide, I'm basically trying to just show you all what ESG is. What you see in the red circle is traditional fundamental analysis. Traditional fundamental analysis does not necessarily capture the many intangible drivers that could impact a business. Ladies and gentlemen, please note that as we have moved, or as we move from a manufacturing-oriented economy to a more services-led economy, the intangible factors driving a business tend to have a far bigger impact than a consideration of the traditional financial parameters which traditional reporting frameworks assess. Take for consideration things like brands, goodwill. Any of these factors, if there is a problem with a brand, with goodwill, it leads to very significant reputational damage, as we shall see in the 2 to 3 examples that we have moving forward. And many of those reputational issues tend to impact an organization, not just in the near term, but for many years after the issue has hit. And therefore, the additional insight value of ESG integration with fundamentals comes from the fact that in these intangible assets are emerging as being even more important than traditional factors, which traditional investing tends to look at. By considering these factors, you are likely to have made a comprehensive assessment. And please remember a very important fact that well-governed companies tend to be companies that are strategic, that have probably been able to assess the likely risks that could emanate not just from regulation, but even from issues such as disruption. And therefore, the expectation is that well-governed companies tend to deliver superior risk-adjusted returns. I spoke about reputational damage. There are 3 cases on ESG which I'll allude to very briefly. From an environmental, social, and governance perspective, I think all of us are aware of the Volkswagen scandal, which hit in September 2015. Volkswagen sold cars in the US which were fitted with defected devices to circumvent emission tests. Look at what happened. Look at the financial impact. The stock price dropped by 36% in the immediate aftermath. It has barely recovered to those levels and continues to stagnate. Volkswagen has paid close to 28 billion euros in fines. And recently, the CFO of Volkswagen spoke about class action lawsuits still continuing. So this is an example of how reputational damages impacts a corporate. Now, why is this a good example? This is a good example because funds that invested on the ESG theme had avoided the Volkswagen stock before this scandal happened. Now, you might say that how could any fund have predicted something like willful deceit, which is pretty much what this scandal was all about? The answer to that comes from the fact that Volkswagen always had very poor governance rankings. The company did extremely well from a financial standpoint, and therefore all those funds, all those investors who assessed this company just from a financial standpoint, but not from an ESG perspective, invested in the stock. So this is an example of what ESG analysis helps you. It not only helps you avoid tail risks, but it also allows you to invest in companies that are extremely proactive and not prone to such violations. I won't go into the details on Equifax and Nissan. I think we've all heard about that. Nissan has been the most recent corporate governance-related example. We've seen what's happening over there. The stock price has dropped by 12%. Its CEO continues to be in prison. And there's a lot of questions on the very poor corporate governance practices at that company. Once again, Nissan has continuously ranked at the bottom end of the ESG rankings, and many funds who invested on ESG have avoided Nissan. I don't need to talk about what ESG is here. Here I'm just going to talk about how we are seeing assets under management under responsible strategies move up. So what you see over here is AUMs under responsible investment strategies. Today it stands at close to 26%. So 26% of investments globally take into consideration ESG factors. This was far, far lower in 2012. And please let me tell you that when the data comes out for 2018, it is not yet out, we expect that the figure, which was 25, 26%, will probably be higher than 30%. So clearly this is becoming a norm that is being embraced. And for all of us sitting in the room, the view here is that increasing pools of liquidity are going to start moving towards companies that are well governed. And therefore, there is a likelihood of well-governed companies getting re-rated as more and more capital moves to these companies. An example, does ESG result in sacrificing performance? I've got data for India, for EM, for Europe. As an illustration, we have the United States over here. And you see that ESG-focused funds have outperformed the normal or the benchmark funds. So clearly, there is no virtue discount for ESG. And now a very brief view on what is going to drive ESG from niche to norm. I'll talk about 2 to 3 over here in the interests of time. First and foremost, demographic shifts are driving a rapid change in investor profiles and investment preferences. I'm sure all of you are aware of the fact that over the next 20 years, we are going to see a massive intergenerational transfer of wealth, particularly in the United States. The baby boomers are set to transfer wealth to the millennials. And there are various estimates of what could be the size of this intergenerational transfer, and it's expected to be anywhere between 20 trillion to some estimates put it at 25 to 30 trillion. Now, the reason why I say this is important from an ESG perspective is because millennials are extremely responsible investors. So there are various surveys that state that millennials are beginning to demand investments with well-being as one of the objectives as well. Millennials are far more aware of various issues such as climate change, climate variability, environment, etc. And these millennials are demanding that if my money is being invested in a company, I want to park it in a company that is responsible. So therefore, we think that over the next 5 to 10 years, ESG investing will become the norm, not just a niche. Another factor that I want to talk about is climate change. I don't think we need to talk about climate change. All of us are aware of the massive risks of climate change. We are living in India. We are experiencing air quality issues. So clearly there needs to be something that the regulator needs to do on air quality. So over here, why is this important? Why is this going to drive ESG investing? From both, this will happen from a push and pull factor. We spoke about the push factor. Now let me talk about the pull factor. You know, between 1997, when the Kyoto Protocol was announced, and today, we've seen climate laws around the world move from just about 40-odd laws to 1,400 laws. Now think of what could happen if an organization is not in compliance with this plethora of climate-related laws. There could be serious risks of violation, which could result in fines, which could result in reputational damage, etc., etc. So clearly, this is an example of the pull factor for ESG, where regulation is going to lead companies to disclose more and more on many of these issues. And this will be a virtuous cycle because the financial industry is an allocator of capital. And if the investors are demanding responsible products, the companies will be expected to follow sustainable strategies, and eventually this helps everyone, the regulator, the environment, the consumer, the company, ultimately leading in better risk-adjusted returns. And the third important thing is good governance has become systemically important. I think this is explained very well by what it is. Don't need to go into those details. And therefore, I guess a consideration of all of these factors is going to lead ESG investing from niche to norm. In India, we are still at the infancy of this very, very important investment theme, but we are very confident that this is going to be embraced very well by investors. In fact, we are already beginning to see foreign institutional investors increasingly divert money towards responsible companies. Many of us have wondered, why do companies like Hindustan Unilever trade at these valuations despite its earnings growth being just about 15%? The answer, ladies and gentlemen, is Hindustan Unilever is an example of a company that ranks very high on ESG criteria. It is a sustainable company. It is a responsible company. And I think to all of us as investors, we want to invest in companies that can show us longer-term returns rather than be focused on what the next quarter or the quarter after that is going to be, because that is the essence of fundamental investing. I'll close this presentation by saying that ESG investing is nothing but fundamental investing in responsible companies. Thank you very much for your attention this evening. I don't know if we have time for questions. Okay, I'll be happy to take questions, if any. No questions, right? Yes, please.
Can you try to correlate ESG with respect to corporate governance?
So corporate governance is pretty much part of the whole ESG thing, right? Because what is ESG, as I said? Environment, social, and governance. So governance pertains to the corporate governance pillar, which is everything related to board oversight, the independence of the board, the gender diversity on the board, all the things that go in terms of the relationship between the corporate and the shareholder, minority shareholder rights. So as I said, all stakeholders. The G pertains to a corporate's responsibility with the shareholder. The E pertains to the corporate's responsibility with the regulator and with society as large. And the S is the relationship between the corporate and the human capital, the people of the organization. So it's all encompassing.
Thank you.
Yes, please.
You have shared 3 examples which are essentially based out of the US, without doubting the utility of ESG.
Sure.
Now, many Indian companies find it difficult to reconcile themselves to FCPA, etc., the ones which come from Foreign Corruption Prevention Act, which comes out of the UK. Would you be able to share an example of an India-based company with Indian investors where we have seen like those 3 examples and difference in returns?
So, look, in India, we haven't really seen any major example of an environmental issue. Probably Vedanta could be one of the issues. You know, Vedanta recently had an issue with Tuticorin, right? So that could be an example of an Indian issue, but Vedanta clarified, Vedanta is now, moved to the courts, etc. So we shall have to see how that goes. Another incident on governance was ICICI. And I think India's biggest corporate governance scandal probably may have been Satyam, which was, I guess, 2008 or 2009. Now, Satyam obviously happened more than 10 years ago, so all of us have forgotten. But, Satyam was India's Enron. So we have had these issues in India. Now, what will happen moving forward is disclosure levels are going to increase. So clearly, the riskiness of these scandals should reduce because the companies will start seeing what these scandals mean to the stock price as well as the reputational damage for the companies. Right. If there are no further questions, thank you very much for your time. Thank you.
Thank you so much. Now, I would like to extend a vote of thanks to all of you. A special thanks to our sponsors, our commodity awareness partner, MCX, our trustee partner, Amicorp,